Now you've got this shift in the petrodollar and this slow shift in energy payments and rubles. It's a game changer. Again, in many ways, February and March of 2022 are as important to 1971 August when we got off the gold standard. There's been incredible seismic changes in the last few months with the dollar.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And with us today, a new guest, Matthew Piepenburg, renowned author and commercial director at Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Well, thanks for having me. I'm looking forward to the conversation.
Definitely. It's great to have you. And you've been talking about for quite a while that there's a need for a monetary reset. And this really boils down to how there is so much debt in the world right now. And we can talk about what's happening in the US, what's happening in Europe, what's happening in Japan. It seems like all around the world, countries are just in so much debt right now that something is going to break. Can you expand on this?
Yeah, it's an incredibly important topic. And throughout history, it's kind of a cycle that we've seen from ancient Rome, or the first trading desks of Persia, to 18th century France, 20th century Weimar, 21st century Yugoslavia. It's actually quite sad. And from really the first mathematicians or the first kind of philosophical historians, from David Hume to von Mises in the early 20th century, have said the same thing. And it comes down to this: debt destroys nations from every regime. Extreme debt leads to a financial crisis. It leads to a market crisis. It leads to a currency crisis. Ultimately, it leads to social unrest, which leads to a political crisis. And then that ultimately leads to some form of extreme form of control over our financial and personal lives, whether that's from an extreme left or from an extreme right. And we're seeing that play out in a lot of areas. And you talk about the need for a financial reset. It's almost not even need, it's just an inevitable consequence of the drunken driving by central banks over the last 15, 20 years in particular. The IMF came out in 2020 with this notion of a new Bretton Woods 2.0 to kind of relook at global debt and relook at global currencies, and even relook at the US dollar as a world reserve currency. And the pretext for that conversation in 2020 was rather disingenuous, because they were really poking and pushing all the blame at the COVID crisis and the fiscal and monetary policies that followed the COVID crisis. And there are lots of different views on the policy reaction to COVID. That's a rabbit hole. My opinion was it was an extremely poor policy reaction at every level. But the simple fact is the debt crisis and the credit crisis in the US and globally was there long before COVID had its first headline. And it was certainly there long before the war in the Ukraine. So this kind of disingenuous attempt to say now, because of the war on COVID, we have to have a Bretton Woods 2.0 currency reset, debt reset, like we did just before the end of World War II, was incredibly thin and lazy thinking. To compare the COVID crisis, or even now the war in Ukraine, to the immense destruction that occurred in World War II all over Asia and Europe, when there was about, depending on what data you look at, 65 to 75 million people killed, and economies from Tokyo to Frankfurt to London were destroyed, in Paris. So to compare the COVID crisis to World War II, and hence the need for a new currency system based on COVID, I think is an insult to the suffering and the true catastrophic consequences of the Second World War. Nevertheless, because of 300 trillion debt and counting global, in 90 trillion combined household, public, and corporate debt in the US, COVID became an incredibly convenient and helpful pretext for this need to start over, so to speak, which of course is not that easy. It's certainly not that orderly. And so the very narrative behind the new kind of reset, I think, was disingenuous. But nevertheless, what it boils down to is because we have so much unsustainable debt in the world, regardless of how they blame it on COVID or whatever. It ultimately comes down to incredibly disingenuous and wayward and I think reckless fiscal and monetary policies, really since the great financial crisis, but long before then. We've simply been living beyond our means as a nation, and many of the companies on the S&P, the Dow, and the NASDAQ have been living beyond their balance sheet needs in terms of their financial management. So with all this debt and something to blame or someone to blame, they'd like to come up with a new kind of central bank digital currency using blockchain technology to have, well, again, I'm simplifying, but basically what comes down to an e-yen, an e-dollar, an e-euro that can be tracked through blockchain technology, through our commercial banking systems, to slowly wean us away from paper currencies or even US dollar reserve currencies. Is kind of like a glorified electronics SDR from the IMF. So that will have all kinds of ramifications. It's, to me, unless it's backed with some linkage to a commodity or precious metal like gold, it won't have credibility. It'll just be a new form of fiat money to pay new forms of debt. Again, I don't see a one-to-one linkage with the gold price, but I think for it, and even the IMF in its 2020 report, which again was full of false blame to COVID and not any accountability towards central bank or BIS policies in the last 15, 20 years, despite the lack of accountability, even in the IMF report, they were basically having gold as some form of kind of neutral asset behind this blockchain technology to give some type of chaperone to this new digitalized currency. And again, it's inevitable whether we like it or not, simply because the current system is cracking. It's cracking. It's been cracking. It's been accelerated by the war in the Ukraine and by the sanctions, which have completely backfired on the US dollar and backfired on Western systems. Without taking sides for Putin, it simply has backfired. But however this new digital currency or this new global reset occurs, it will be disorderly. For the one thing, you won't have the participation probably of China and Russia and possibly India and other countries. So it's not going to be a kumbaya where all the nations of the world just agree unilaterally to come in and collectively cooperate. And in between now and then, there's going to need to be a series of accelerants and crises to justify this. And that will probably be seen in risk asset markets tanking further despite spikes and dead cat bounces. Credit markets are overstretched, equity markets are overvalued. So there'll be a lot of market unrest. There's continued social unrest. And then again, with the idea that this is because of things beyond the control of policymakers like COVID or like the big bad bully that Putin is, without taking any accountability on the West for their policies or their statesmanship or lack of statesmanship, there'll be a need to get together again in some room like they did in 1944 to change the financial system. At that time in 1944, when they did this, the US dollar was backed by gold. So there was a sense that there was some neutrality to the US dollar. There was a chaperone, so it wouldn't be overcreated because it was backed by this precious metal. There was also an undeniable recognition in the wake of that catastrophe that was World War II, that there was something needed to be done, and America could be a leader in that way. Because at that time, America had not only saved militarily Europe, but it was the world's greatest manufacturer and the world's creditor. Today, America has outsourced the vast majority of its productivity overseas, ironically, to China and certain parts of Central and South America because of cheaper labor costs. And we're no longer the world's creditor, we're the world's debtor. So it's a very, very, very different environment. The US will not be as credible in the future as it was in, say, 1944.
No, when I hear the word reset, I mean, a lot of people have been talking about this. The World Economic Forum was even talking about like the Great Reset, and people are talking about now the monetary reset. When I hear the word reset, it's almost like everything is wiped out and then a new system emerges. Is that how you see it playing out, or will we just kind of transition into the new system and, the currency that people have right now will just become the new currency? Or how do you see that all playing out?
Right. Well, I'm speculating myself because we really don't know. Nothing like this has ever really been tried. In 1944, there was a ripe awareness that they'll try anything. That's how desperate things were. And America and its dollar at the time was an obvious choice. In terms of just a nice, clean reset, and we just kind of wipe away the old debts, we start over again like some kind of global Chapter 11. Even in law school, Chapter 11, Chapter 13, any debt restructuring, any distressed debt, it's always a zero-sum game. You can't just eradicate debt and everybody feels better. There's always a creditor and there's always a debtor. So if you wipe out the debt, there's a creditor that's in pain. If you expand the debt, there's a debtor in pain. So it's not necessarily just a simple idea of, look, I'm going to forgive your debt, you're going to forgive my debt, we're going to create this new blockchain centralized currency, and we'll start over again. There'll be winners and losers, and there'll be resistance, and there'll be all kinds of mechanizations to negotiate how that's done. And then when this new currency comes in, if it's an electronic central bank digital currency from, say, the US central bank, the Japanese central bank, and the European central bank, how are we going to allocate a free-floating currency within that system? How are we going to allocate valuations? Which debts are we going to forgive? Which creditors are going to be punished? That will be extraordinarily complex. And frankly, Elijah, I can't possibly give you an easy answer on how that will work. I don't even think they know themselves, but I do know that it's never that simple. And I think between now and then, like I said, there's going to have to be more and more urgency. That urgency will have to come after massive deflationary markets, not deflation in terms of the money supply or the debasement of the currency, but after markets see significantly more mean reversion than they've seen in the last few weeks. And when there's more and more headline blame towards something they can justify this with, I think what's happening, though, despite their best efforts to point the fingers at extraneous events, black swan type events, these black swans like COVID and the war in Ukraine were hardly black swans. They were quite white, in my opinion, or at the very least gray. These were very avoidable, foreseeable crises. And I think more and more citizens and more investors are waking up to trusting their own instincts and getting more and more informed that this is really the fault of our own policymakers. Again, that's not taking a left or right opinion. It's been the fault of liberal and, or you could say left and right policymakers, left and right White Houses and regimes, left and right leadership in Europe, whether that's in France or Germany. They're all guilty of the same sin of living beyond their means and pretending that that's a solution, or solving a debt crisis with more debt, which is then monetized or paid for with money literally created with a mouse click. That's simply an unsustainable fantasy. And yet, for over 15 years, that fantasy, this idea of quantitative easing or modern monetary theory or creating money out of nowhere to pay for our debts, to keep interest rates down, and then buying the greatest risk asset bubble in the history of modern capitalism, the idea that you can pay for that with money out of nowhere and that it works and it creates a massive market euphoria and then that's sustainable, that's a fantasy that simply was too good to be true. But it's been through cognitive dissonance and a ripping market over the last 10 plus years. No one wants to admit that that is too good to be true. And it's kind of a crude analogy, but you can't go to a keg party and drink ad infinitum without a hangover. You can pretend that there's no hangover. You can pretend to drink a Red Bull or a Bloody Mary to avoid the hangover, but eventually the liver damage to the system is done. There's no escaping the consequences of that type of drunken behavior in central banks, whether that's in the US or Europe or Asia. And there's no way of avoiding the consequences of that much debt. At some point, the house of cards collapses. In the meantime, there's been a cycle of tremendous euphoria, and the markets have given investors the greatest returns I've ever seen. And I was trading through the dot-com bubble and the great financial crisis of 2008. I've never seen risk assets in credits or in equities this grotesquely overvalued. Never, not even academically, not even studying them theoretically, but having traded through the dot-com bubble and the great financial crisis, what I'm seeing on the tapes now is beyond anything I've ever experienced personally. It's the worst macro environment I've ever seen.
What fundamentals are telling you that the markets are overvalued at the moment?
Well, on the credit side, which is an important question, Elijah, because I think one of the things I learned in Wall Street is the kind of the varsity players or the bond jocks, the guys who traded credits. Those are the smartest guys in the room, the guys working the bond desk at Goldman or JP Morgan. And the reason they were the smartest traders, I think, is because they understood yields and spreads. And so when you understand risk in debt markets, you can see where credit markets influence equity markets. So the stock market follows the bond market. And when you want to see a grotesque example of overvaluation, you start with the bond market and you drift into the equities market. But look, if after 2008 in particular, when nobody wanted to buy our mortgage-backed securities because they were toxic waste, hot potatoes, and nobody wanted to buy our U.S. treasuries, and no one wanted to buy our debt, well, the solution was, look, very simple. Let's crank out a money printer at the Eccles building and let's buy them ourselves. Let's drink our own Kool-Aid. Let's buy our own bonds to therefore keep their yields down, because as the bond price goes up, the yields go down, and yields and interest rates are correlated. So by controlling yields and controlling interest rates through purchasing bonds with money created out of nowhere, they were able to buy years and years of repressed interest rates, which is the greatest tailwind for the stock market, because that means stocks or companies on the S&P, the Dow, or the NASDAQ can borrow, extend, and pretend at low interest rates, buy back their own stocks, and pay for tomorrow's debt with today's loan, which pays for yesterday's debt. So this idea of low interest rates in the credit market, created by central bank policies, has created the biggest bond overvalued bubble in history, which then created the biggest stock overvaluation. And one way to see how that looks in terms of a symptom, what are the signs of that overvaluation, is when you have basically negative real rates in your bond market, when your own IOU from Uncle Sam, when adjusted for inflation, is negative. That's the sign of a grotesquely overvalued bond market. In Europe, for many, many years, sovereign IOUs, sovereign bonds, not even adjusted for inflation, but purely on a nominal basis, were offering you negative yields. In the US, at a certain point was as well. When you have a negative yielding bond from a nation, that effectively is a defaulting bond. You're losing money the moment you pay for it. Of course, when you adjust for inflation, that's another grotesque sign of a negative yielding bond. So to me, the first sign in the bond markets overall is you have negative yielding sovereign bonds. That's a sign of a terribly overvalued bond market. In the corporate bond market, you see a very small sliver of investment grade bonds. There's not many left because over 65% of the U.S. corporate bond market is junk, high yield levered loans. Those are the C-minus students in the bond class. That's the majority of our bond market. It's the weak and the weary. It's the island of misfit toys. So our bond market is a distressed asset market, sadly. And even the investment grade market is pretty weak and it's not giving you high returns. Another classic symptom is junk bonds. Junk bonds are junk bonds for a name. They have junky credits. They're supposed to give you huge yields. They're giving you almost no yield. It's a no yield. They call it the high yield market. It's a no yield market. So even from junk bond to investment grade, you're not getting much income in your fixed income. So the bond market is grotesquely distorted. And the distortions in that bond market have drifted into the stock market because by keeping rates repressed and buying this euphoria, this bacchanalia we've enjoyed since 2008, stocks have ripped on low debt, on debt rollovers, and easy access to cheap credit. And that is how all credit and equity cycles boom and bust. Low interest rates, easy access to debt creates the biggest party on Wall Street, which eventually ends when those interest rates start to climb up. The cost of debt, because interest rates are the cost of debt. When the cost of debt rises, bond and stock markets start to wheeze, cough, kick, and eventually die. And that's what we're starting to see right now in May and June of this year. And it's only going to get worse unless the Fed pivots and breaks up the money printer, prints more trillions of dollars to buy bonds to keep interest rates and yields down. And all that does is, again, postpone the hangover. But by printing trillions of dollars like they did in 2020, that debases the currency. So you can buy back the stock and bond market's recovery, but by doing so, you're adding water to the currency and you're diluting it. So it's a lose-lose scenario, in my opinion. There's no way out. The Fed has basically given itself no good options.
Now, you mentioned earlier that the world we're going to be entering into is going to be really multipolar, right? There are going to be, there's going to be many different monetary systems around the world. For the longest time, what we've known is kind of the dollar being king, right? Dollar hegemony. That's what everyone alive today has known. But that world is changing, and we're seeing countries moving away from the dollar, and the system we are moving into might not be really based on the dollar. That dollar may not be the world reserve currency going forward. And I wanted, if you could touch on that, and also how the sanctions on Russia are backfiring and just exacerbating this situation.
Yeah, it's a fantastic question. Both bookends of that question start with the dollar and the sanctions. So 1971 and 2022. And a good friend of mine and an advisor to Matterhorn, Grant Williams, said in many ways, what happened in February of 2022 with the sanctions, February and March, was as big a watershed in the dollar's history as 1971 in August when Nixon closed the gold window. So to start from those two extremes and answer your question, the U.S. dollar's hegemony, its days of hegemony are over. They are over. It's a process. It's a slow process. My entire life, I was born in 1970. Nixon closed the gold window in 1971. But when Nixon closed the gold window and took the gold chaperone away from the dollar to get himself reelected because he needed more money, And he didn't have enough gold to print more money. So it's very simple. I'm just going to get rid of the gold standard. It gives us unfettered rights to create more money and get him out of a pickle. So he was reelected, got himself into office. But what he did was effectively destroy the currency from that point on, very slowly. But it's a long process. The process of my life, I've seen the rise and fall of the U.S. dollar. So when Nixon, closed the gold window in 1971, it left the dollar unfettered, no chaperone. Now we could create as many as we want. For years, we were the world reserve currency. We were running on the fumes of our prior reputation. We could export a lot of our inflation to developing economies that were borrowing in U.S. dollars, had to pay back in U.S. dollars. So there was still demand for the U.S. dollar. Most importantly, we had the petrodollar deal, which we did with Saudi Arabia in the 70s. It was no coincidence that after we got rid of the gold standard, we needed a new source of demand for the U.S. dollar to keep the dollar strong. And by creating a contract with Saudi Arabia where all petrol, all oil has to be bought anywhere in the world in U.S. dollars, it's a brilliant way to keep demand for the U.S. dollar strong. So we closed the gold window and we opened the petrodollar. What happened, to your question about Putin and the sanctions just recently, was I joke, but it's not funny. We were aiming our sanctions, aiming our financial weapon at Putin, but we shot ourselves in the foot, because all that did was twofold. First, it just created an even tighter alliance between Russia and China. Russia and China are not Venezuela and Iran. They're much more powerful economies, much more powerful countries, and they're nuclear countries. So you can't play games with those type of countries the way we could bully the other parts of the world as we've done for decades. So first of all, it just created a stronger alliance between China and Russia, which is never a good thing. And it also just forced China and Russia to do what they've always wanted to do for the last 10 years, is they've been looking very carefully, and I'm not a fan of Chinese or Russian policy or Chinese or Russian politics, but they're not stupid. And they've been looking at the West going deeper and deeper into debt, the dollar being created more and more by the central banks. They see that we're over our skis in debt. They know that the U.S. dollar is losing credibility, that it's not the dollar that it was pre-71 or when America was the great country that saved the world from fascism in the 40s. And they've been looking for any kind of context to get away from the U.S. dollar and do transactions outside the U.S. dollar. And by putting these sanctions on Russia, the big joke was, or the big story was out of Washington, that Russia will go broke before the West runs out of energy. That's simply not the case. What's been shown is that Russia has far less debt than the West. It has greater FX reserves. And by freezing Russia's FX reserves, its SWIFT accounts, its access to SDR from the IMF, all that did was make Russia and China do more deals together, and Russia reach out to countries like Germany and Austria, which are massively dependent on Russian oil, to start paying for their oil and gas in rubles instead of dollars. And now countries like China and India and even France are in negotiations with Arab states to buy oil outside the US dollar. Again, it's a slow process, but it's a slow change towards the slow demise of the petrodollar, where it's no longer going to have to be oil and gas are no longer have to be purchased, or oil does not have to be purchased in the US dollar. That's going to mean less demand for the US dollar, less appeal for the US dollar, less need for the US dollar. And I'm not saying that the dollar will lose its world reserve currency status tonight or tomorrow. It's a slow process. But when you tack on years of profligate spending by the central bank and the Congress of fiscal policy, and profligate money created by the Fed and by the ECB and the Bank of Japan, that has lost the credibility of the US dollar. It's diluted its value. Now you've got this shift in the petrodollar and a slow shift in energy payments in rubles. It's a game changer. Again, in many ways, February and March of 2022 are as important to 1971 August when we got off the gold standard. There's been incredible seismic changes in the last few months with the dollar.
And coming full circle here, then the need for the future is some sort of gold-backed system, as we were talking about. Now, what is your take on people who are holding precious metals right now? Will that give them a leg up, or how will that impact the people who take action now and purchase precious metals? How will that impact them if we do end up going into a precious metal backed system?
Look, I'll be full disclosure. I'm a principal at the largest private gold vault in the world, and we buy and sell, refined precious metals or gold out of Switzerland, and we store it in the most advanced private vault in the world, which is based in the Swiss Alps. So I have a bias, but it's a bias that I came to naturally, not by my curriculum vitae. So I have a strong view that gold is ultimately going to and already having the last laugh over fiat currencies. That's not the commentary of a gold bug who works in Switzerland. It's just the net result of years and years of watching markets and currencies behave in a certain way and appreciating the history and math of currency risk. So to answer your question, first of all, whether or not gold becomes a partial linkage in the new world order, in the new central bank digital currency, which I think it will, gold will certainly outshine any new currency or current currency in terms of its inherent purchasing power. The relative strength of the dollar versus the yen, the yuan, the euro, the peso is important if you live in those countries. But the bottom line is, since Nixon closed the gold window in 1971, every major global currency, including the yen, the euro, the British pound sterling, and the US dollar, has lost 95% or more of its inherent purchasing power versus, say, a milligram of gold. So gold is already clearly more resilient and anti-fragile than a fiat currency. And whether the new central bank digital currency is backed 20%, 15%, or 10% by gold, gold will only get stronger because these other currencies can only get weaker. Look at the Japanese yen. They have literally bought 50% of their bond market at this point. I mean, they're printing yen to support their markets. The yen is now at a 50-year low. It's not the world reserve currency, but it's doing what every currency does when you add that much dilution, by that much overcreation, that much broad expansion of the money supply, ultimately at some point destroys the currency. The US dollar has avoided that because of petrol demand, because of money market demands, because of euro dollar demand, because of derivative demand. But even the US dollar is slowly starting to suffer the consequences of decades of this type of policy. So to answer your question, whether you own coins at home or in a safety deposit box, or whether you have it stored in a fancy vault in Switzerland, and you're thinking like an investor, not a trader, and you're playing the long game, not just the putting green, it's not smug. You are going to be far more protected than someone who's got cash in a checking account or in a savings account or in a portfolio or in your wallet. Because none of these currencies, the British pound, the euro, the peso, the yuan, the yen, without some type, are going to outsurvive or have stronger purchasing power than gold. Simply never will. They haven't since 1971. The paper price can fluctuate on the COMEX market, forward contract manipulation, and all that open fraud that is the futures and forward market in the COMEX. We all know that already. But the simple fact is the inherent purchasing power of that coin or that bar is wise. It is wise. From a biblical perspective to common sense, it is the wise choice. And again, many will say that's just gold bug posturing or selling your book. But, I came to gold as a former hedge fund manager who dealt with US dollars in equities and bonds. And I looked at my wealth in terms of my portfolio value. But that whatever dollar amount you have that you're staring at is losing inherent purchasing power by the second. And I'm not saying you have to hug your knees and only buy gold and get out of markets. Unless you want to trade them, they're very dangerous. But however you measure your wealth, if it's in a fiat currency, it's getting weaker every day. Inflation is an invisible tax. It's eating away at that. Gold is one of a few solid hedges against that. More importantly, I think it's going to rise in relative value against those currencies astronomically. The fact that it hasn't this year doesn't bother me. It's certainly acted far better than any other asset class out there. So again, may seem like a bias to me. It's just, it's being blunt. It's my honest opinion. It's Egon von Greyer's honest opinion. It's many people's honest opinions who've had these views for years. And I'll stand by it completely. I think you have to play the long game here and recognize that gold can only go up because currencies can only go down now. Sadly, it's not something that I relish, to be honest. This is the consequence of years of profligate behavior in the bond and stock markets, thanks to a central bank near you.
It is interesting that since we have seen the value of the dollar decline very rapidly in the last year or so, as we've seen high inflation, gold and silver haven't moved quite a bit. They haven't made dramatic moves. Your take on that, and what do you expect for the near future?
It's an absolutely fair question. It's the $1 trillion question in a lot of ways. The first answer I would say is, look, the US dollar is still the best horse in the glue factory. And as long as the US dollar is stronger than other currencies, there's still going to be a headwind for gold. There's no doubt that when the dollar is relatively stronger than other currencies, or when Larry Summers gets around with Powell and Biden and discuss ways to make the US dollar more attractive or markets more attractive by raising rates, that also, you have a high rate or a higher rate environment or a stronger dollar, that can buy time and be a real headwind for precious metals. But ultimately, I think those are very temporary headwinds. At the end of the day, and no one, myself included, will ever take, well, next fall or this August or by September, you're going to see gold at 2,400. No one knows. I know gold will go much higher for the reasons I've discussed, but you keep in mind that although gold has not reached its $2,400 target for the year, even Goldman Sachs, Jeff Guthrie, who's the head of commodity research, at the beginning of the year said you've got record high ETF purchases of gold, you've got record high central bank purchases of gold, you've got record high physical purchases of gold. So gold is targeted even by Goldman Sachs at 2,400. We're not even close to that right now. We're not even close to the August 221 high. So what I see happening is really, keep in mind that gold, and this is not an apology for gold, but while the NASDAQ dipped -30, and when the S&P went into bearish territory, -20, and when Bitcoin lost 70%, gold wasn't ripping to 2,400, but it was holding its own as a loyal asset, despite clear and obvious manipulations in the COMEX market with that permanent short by the big BIS banks and the bullion mix, trying to short the paper price. And even with the rising dollar and even with rising rates, gold stayed in that 1,800 to 1,900 range where it sits today. The fact that gold hasn't gone underwater like everybody else is an amazing sign, especially in this environment. And typically when markets tank or start to fall by 10, 20, 30%, gold can be sympathetic for a period of months. And then eventually it diverges and rips north. And we've seen that before. And we're also seeing a commodity cycle that's not nearly its near highs. It's going to go much higher. So for patient investors, absolutely, it's not a promise. I can't time when. I just know that the commodity cycle in the direction of gold is up and to the right. In the meantime, inflation is an invisible tax. It's hurting the poor more than anyone. The middle class is already strapped. And to have 8, 9% reported inflation when we know that the real number is closer to 20%, 19% when you use the old Volcker scales of the 80s, this is a crippling period. And it's very hard for people to go to Switzerland and buy a bar of gold, but anyone can buy coins. Anyone can buy a small amount and start doing their best to preserve the purchasing power of their money. Because I look at, it's a cryptic answer, but we have health insurance, we have car insurance, we have home insurance, we have even life insurance. We don't have currency insurance. And I look at gold as one form of insurance. And at the end of the day, I'm just an insurance salesman. When I believe that precious metals in general, and gold in particular, are essential now. It's not a theoretical question. And I don't care whether Bitcoin regains its highs or not. I've never been against Bitcoin, but it certainly was never a store of value or an alternative currency, in my opinion, the way physical gold is. And the behavior of Bitcoin this year proves to me, at least, that it was effectively just a technology growth stock with a multiple move up or down based on where the NASDAQ went. Many will say that's blasphemy. I understand. I'm not here to push gold by making fun of crypto. But I'm saying what I've always said, and we've always been writing for years, is gold is not a crypto. It's much more loyal. It's much more stable. And it's not a barbaric relic of the past. It always gets the last laugh when nations and regimes and countries are this much in debt and the currency gets debased.
All right. Well, Matthew, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts and where they can find you online?
Well, look, we're at Gold Switzerland. Our group, Matterhorn Asset Management, is at goldswitzerland.com, so it's an easy URL. Egon and I finished a book that came out in May, which is called Gold Matters. It's really inexpensive on there's a paperback version, but the ebook is really available to anyone. And I think for those that are on the fence, pro or con, anti or pro gold, I think it's a pretty objective, sober look at why precious metals are needed today. And the first half of the book really talks about the history of debt cycles, whether you're going back to 18th century France or Greece or Rome to today. What we're seeing is nothing new under the sun. So I think it's a nice way for people that are new to gold or looking for confirmation to get some good data in a user-friendly read. And so Gold Matters is a book we highly recommend folks take a look at.
Perfect. We'll put that in the description of this video. Once again, thank you so much for your time and God bless.
Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations. and the metals are reserved for you, awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.